Hi, so today we are going to do the debrief for our FR mock for the June 2026. So the exam I set was one of the practice exams, and we're going to go through the debrief with the section C questions, starting with the first question in section C. Always start by reading the requirement. Part A is asking us to calculate the consolidated goodwill at the date of acquisition of Rakewood Company. So this looks like a group accounts question, as you can see. And Part B, they want us to prepare the consolidated SOPL for Laurel Company for the year ended 30th September 2016. So let's read the scenario. They're telling us that this scenario relates to two requirements. On 1st Jan 2016, Laurel Company acquired 60% of the equity share capital of Rakewood Company in a share exchange in which Laurel issued 3 new shares for every 5 shares it acquired in Rakewood. So the purchase consideration here, the first part is asking us for goodwill. And remember the formula for goodwill, we're going to have to take the cost of investment from the parent's perspective. Plus, in case it's the full goodwill method, which we will read down, we will need to include the value of the NCI. And from that, we subtract our net assets. Okay, so one of the things involved in the cost of investment, they've not clearly told us the cost of investment. They've given us what it's made up of. And you can see that, first of all, they've told us that there was a share consideration. And the share issue has not yet been recorded by Laurel Company. Additionally, on 31st December 2016, Laurel Company will pay to the shareholders of Rakewood $1.62 per share acquired. So that's called deferred consideration, isn't it? Because they're going to pay it 1 year down the line. So deferred consideration, remember we said that for deferred consideration, you have to take the present value, you have to compute the present value of the deferred consideration. And since you're paying this after a year, anytime you have deferred consideration and you compute present value, you also have to do unwinding of the discount. Unwinding of the discount is going to be a finance cost. Remember, that's the interest expense. So when we are preparing, Part B is asking us for the consolidated SOPL. When we are doing the SOPL, we need to remember to include the interest expense with regards to this deferred consideration. Okay, so as you're reading these things, it should strike you by the time you've practiced enough. When you're reading the scenario, you already have to keep in mind what should go where, okay? So we know that we're going to use this deferred consideration in Part A, but remember to also include it in Part B. At the date of acquisition, shares in Laurel Company and Rakewood Company had a market value of 7 and 2 each respectively. Why are we given the share price? Because of course there was a share consideration, so we will use the share price to value that, and maybe we'll need it for something else. Let's read along, okay? So they've given us the SOPL for the year ended 30th September 2016. If the year has ended on 30th September 2016, of course it would have started on 1st October 2015. Now, Laurel, the parent, acquired this subsidiary on 1st Jan. That means it's not a full year acquisition. It's a mid-year acquisition. You can see January to September, that's 9 months. So when you're preparing the consolidated SOPL, you're going to have to apportion everything for 9 months, okay? So keep that in mind as well. Dates are important. So always look out for the dates. So they've given us the SOPL and they've given us equity at the start of the year, at 1st October 2015 rather. They've said that equity was that much in both companies and retained earnings was that. Why are we going to need that? Equity is not relevant to the SOPL, but remember that we've been asked to calculate goodwill. And in goodwill, we need the net assets at acquisition, our working one that we were doing, isn't it? So for that purpose, we will definitely need these figures. And then they've told us the following information is relevant. Note number 1 says, at the date of acquisition, Laurel Company conducted a fair value exercise on Rakewood's net assets, which were equal to their carrying amounts, with the following exceptions. There was an item of plant that had a fair value of 4 million above its carrying amount. At the date of acquisition, it had a remaining life of 2 years. Remember, fair value adjustments have to be made in working one, where we're doing net assets of the subsidiary. So they're telling us that the fair value of this plant had to be 4 million above the carrying amount. So we must add 4 million to the net assets at acquisition. And they've not asked us for the SOFP, but then if we were doing the SOFP at the reporting date column, This is a depreciating asset, okay? So at the reporting date, you also have to make the fair value adjustment at the reporting date, but then you would have to account for the depreciation from January to September. So the fair value adjustment at the reporting date would be lower. Anyways, that's for the SOFP. But also depreciation is going to affect our SOPL, isn't it? They've told us at the date of acquisition, this plant had a remaining life of 2 years. So we're going to have to compute the depreciation on the extra fair value. They included the plant, but then it should have been 4 million above the figure they've included. So that means we're going to have to compute the extra depreciation on the 4 million, and we know that depreciation for the year is an SOPL item. So we're going to have to include that in our consolidated SOPL in Part B. The next thing is that inventory of 800,000 had a fair value of 1 million. All of this inventory had been sold by 30th September 2016. So another fair value adjustment there for us to do. So 200,000, the difference, they said inventory of 800,000 had a fair value of 1 million. So they've included it at 800, but it should have been at fair value of 1 million. So another fair value adjustment that we're going to do is the 200,000 excess, okay? Note number 2 says that L'Oreal Company's policy is to value the NCI at fair value, so full goodwill method, because NCI is at fair value. For this purpose, Rakewood Company's share price at 1st Jan 2016 can be deemed to be representative of the fair value of the shares held by NCI. What does that mean? Generally, in other questions, you see them giving you the fair value of NCI. Here, they've not given it to you, but they've told you how to compute it. They said that you consider the share price to represent the fair value of the shares held by NCI. How many shares are held by the NCI? If you look up, L'Oreal, the parent, acquired 60% of the equity share capital. That means NCI owns 40%, isn't it? But what is the 40%? For that, you need to know the number of shares of the subsidiary. So they've given us, if you recall, they've given us the equity shares. They've told us that they're worth $15 million. But remember, we want the number of shares. So always look out how much is the value of one share. They've told us that one share is $1 each, and the total equity shares are $15 million. So that means this represents 15 million shares. And out of the 15 million shares, 40% is attributable to NCI. So that way you can get the number of shares, and we will multiply it by the share price that has been given to us of Rakewood. They told us Rakewood had a share price of $2, and that gives you the fair value of your NCI. Okay, follow the instructions. It's literally led you on how to calculate the fair value. So we will use that when we do our goodwill. Note number 3 says that L'Oreal has traded with Rakewood for many years before acquisition. Sales from Rakewood to L'Oreal throughout the year ended 30th September 2016 were consistently 1.2 million per month. Rakewood made a markup on cost of 20% on these sales, and L'Oreal had 1.8 million of these goods in inventory at 30th September 2016. So first of all, this is intercompany trading. They've been trading for many years, but from the time they become a group, from January 2016 to 30th September, whatever sales are made between the group, those are called intercompany intergroup trading. And we said that from a group perspective, you can't sell to yourself and say I've earned money, okay? So whatever sales have happened from Jan to September need to be removed from the revenue. They need to be removed from cost of sales. And whatever unsold goods that L'Oreal had at the end of the year, the unrealized profit on those unsold goods have to be added to cost of sales. Why? Because remember, when Rakewood was selling to L'Oreal, they were adding a profit markup. They were adding a markup of 20%. But from the group perspective, the inventory is in L'Oreal's books, the unsold goods. The inventory has been valued at the cost plus 20% profit that Rakewood made on the sale. But think of it from a group perspective. Can I sell to myself and make a profit? Of course you can't, okay? So you will only realize this profit once you sell these goods outside the company to third parties. That is why the unrealized profit, the one that Rakewood would have included in its books, needs to be eliminated. And how do you eliminate it? Instead of reducing the profits, the correct way to adjust it is that we go and increase the cost of sales by the amount of unrealized profit. When you increase cost of sales, automatically your gross profit is going to reduce, right? So that's another adjustment we'll have to do, but that's not for part A, that's for part B when we do our consolidated SOPL. And then number 4 says that L'Oreal's investment income consists of a share of dividend of 500,000 paid by Rakewood in August. So this is another intercompany item, okay? The subsidiary paying dividends to the parent. Obviously, because the parent has shares in the subsidiary, whenever there is a dividend payout, it's going to be entitled to its share. Now, L'Oreal, they are saying the investment income in L'Oreal, if let's go back up. Let's see where the investment income is here. After operating profit, you can see that there's an investment income of 500 in L'Oreal company. They're saying that 500,000 is made up of two things. One of it is L'Oreal's share of dividends. So the entire 500,000 is not by Rakewood, okay? L'Oreal's share is 60% of the 500,000. So 60% of the 500,000 is the dividends it received from Rakewood. That's part of it. And the second thing under investment income is a dividend of 200,000 received from Arctic Company, which is a 25% owned associate, which it has held for several years. So even dividends from associates, these are also intercompany items. You have to eliminate them, okay, when you're doing your consolidation. But now since we have an associate situation, what are we going to include in the SOPL for our associate? Remember, in the SOPL, since it's an associate, you don't consolidate, meaning you don't add together everything like you add for subsidiaries. What you include is the parent's share of the associate's profit for the year. Okay, and they've told us that the associate's profit for the year is 2.4 million. So the parent owns 25% of the associate. It's going to take 25% of that amount. And you're going to include that when you do your consolidated SOPL. Note number 4 says, assume, except where indicated otherwise, that all items of income and expense accrue evenly throughout the year. What does that mean? Remember, this is a mid-year acquisition, 9 out of 12 months. So they're saying that assume that everything, you don't need to bother about thinking of is the revenue earned equally over the years. They said assume that everything is equal. So whenever you're dividing all the items in the SOPL, you can simply multiply them by 9 out of 12, assuming they were equal for each of the months. Lastly, the last note says there were no impairment losses within the group during the year. So no impairment for goodwill. So let's begin our part A. We're going to compute the consolidated goodwill at the date of acquisition for Rakewood Company. So for that, let's put a heading, consolidated goodwill. Okay. Now we need to know the net assets. So let's start by doing the net assets of the subsidiary. At acquisition date, okay, and we don't need the reporting date because we're not doing the SOFP, so we will skip that column. We'll just do the acquisition date. So what is the share capital? First of all, they've told us 15 million. Okay, I'm going to put the 3 zeros there, so I'm not going to keep repeating them. 15 million retained earnings. Now if you observe the retained earnings they've given you, they've told you this is equity at 1st October 2015. That means this retained earnings are the retained earnings at that date, okay? So if you want to get the retained earnings of acquisition date, what are you supposed to do? What was the acquisition date? The acquisition date was a few months after. It was on 1st January. So profit for the year, we know that profit for the year is added to retained earnings, right? And they've told us the profit for the year for this particular subsidiary was 10,400. Now you want the retained earnings at 1st January and you've been given the retained earnings at 1st October. So first of all, what do? You get the retained earnings at 1st October, which is 25,000. And to this, you're going to add the profits for October, November, and December. Okay, so that gives you the retained earnings at 1st Jan 2015, which is our date of acquisition. So how do you do that? Get the profit for the year, 10,400. Multiply that by 3 out of 12. 3 months of profit is what we need, the October, November, December profit. And that gives us 27,600 as the retained earnings. Remember, there was a fair value adjustment for 2 things. So we have to do the fair value adjustments as well, starting with our plant. They've told us the fair value of the plant was 4 million above its carrying amount, as you can see in note 1, and the fair value of inventory was 200,000 above its carrying amount. So inventory 200. And that's it. We can get the net assets at acquisition. Net assets of subsidiary at acquisition is simply going to be the sum of all those figures there. That gives us 46,800 as the net assets of the subsidiary at acquisition. We can now move on to do our goodwill. So, cost of investment. If you wanted, you could continue this down. When you're subtracting net assets, you could do this entire working down as well, okay? If you're comfortable doing it like this, how we did in class, you can start by doing the net assets working. So cost of the investment in the subsidiary, we agreed it was made up of two things. Let's go back up. There was a share exchange. They said that they acquired 60% of the shares in Rakewood in a share exchange in which three shares of Laurel were issued for every 5 acquired in Rakewood. Okay, so you can simply do 3 out of 5 times the number of shares acquired. That will give you the number of shares that Laurel issued. So first of all, how much were the shares acquired? The shares acquired, so I'm going to put a formula there, follow my formula. Open brackets, 3 out of 5 multiplied by the number of shares that were acquired in Rakewood. Now, 60% is what was acquired and 60% of the share capital. Remember when I was discussing the NCI, we agreed that there are 15 million shares. So 60% times 15 million. Okay. Make sure to put the brackets correctly. If you're not sure, do it aside on your calculator and see if the figure matches. But that's only if you're not sure. Or break the working down into smaller workings. Because if you get your BODMAS wrong, the final answer may be incorrect. So 60% of 15,000 is the number of shares we acquired in Rakewood. And for every 5 shares acquired, Laurel issued 3 shares in its own company. So when I'm doing that 3 out of 5 times that amount, the figure there is basically going to be the number of shares that Laurel issued. But we want the dollar value of that, isn't it? So the dollar value, to get the dollar value, Laurel is issuing its own shares. So this will give you the number of shares in Laurel company. But what's the dollar value? To get that, you multiply by the market value of Laurel shares. And what's the market value of Laurel shares? It's going to be $7. Notice I first closed the bracket. Okay, I've closed the bracket so that when I close the bracket, it's giving me the number of shares and I'm multiplying that by $7 to give me the dollar value. So the dollar value of the share exchange is 37,800. There's also deferred consideration. Remember, deferred consideration is going to be recorded at the present value of the future payment. They said Laurel will pay to the shareholders of Rakewood 1.62 per share acquired. So again, this is going to be a working. What are the number of shares acquired? 60% times 15,000. Multiply this by 1.62. Okay. Now that will give you the future value. Now I'm first putting one bracket to do the 60% times 15 million. The second bracket, I'm multiplying it by the share, by the 1.62, which is the amount that they're going to pay per share. But that is the future value, the value that they're going to pay on 31st December. Remember, we need to compute the present value. How do you compute the present value? They've given you the cost of capital as 8%. Sometimes they can give you a discount factor that makes life easier. You simply multiply by the discount factor. But in this case, they've not given the discount factor. They've given us the cost of capital. So we have to use our formula. Present value is equal to future value times 1 over 1 plus r to power n. So times 1 divided by 1.08. N in this case is 1 year only because we're paying the deferred consideration 1 year down the line. If it was more than 1 year, you would have to raise the power to the number of years. Okay, so 1 plus 8% is how I got the 1.08. And when you do that, That gives you the value of your deferred consideration as 13,500. That's the present value of your deferred consideration. Okay, so that's it. Then you simply, the cost of investment there is then going to be 37,800 plus the 13,500 gives us 51,300. To this, since we are using the full goodwill method, we have to calculate fair value of the NCI. They told us that fair value of NCI is going to be based on the share price of Rakewood at the date of acquisition. We know that NCI is 40%. So NCI owns 40% of the shares. So 40% times 15 million. And we need to convert this into a dollar value by multiplying by the share price of Rakewood. So fair value of NCI is 12,000 less net assets at acquisition, which we've already done. So we can cell reference it up. And therefore, our goodwill, they told us there's no impairment. Our goodwill is going to be the cost of investment plus the value of the NCI minus the net assets at acquisition, giving us the goodwill as 16,500,000. Okay, and that's your 7 marks right there. So that's part A done. Part B is now asking us to prepare the consolidated SOPL for Laurel Company for the year ended September 2016. So let's move on to part B. Consolidated SOPL for the year ended 30th September 2016. Okay. We're going to put the value. Starting with our revenue. Revenue, remember, we have to time apportion the subsidiary. Okay, so this is going to be 84,500 for the parent, plus for Rakewood, it's going to be 52,000 times 9 out of 12 because we didn't have the subsidiary for the whole year. But remember from our reading, do you recall that there was intercompany trading? Note number 3 had told us that Laurel had traded with Rakewood for many years before the acquisition. Sales from Rakewood to Laurel throughout the year were consistently 1.2 million per month. Okay, and we had this subsidiary for 9 months. That means 9 months times the 1.2 million would be the intercompany trading. So minus 9 over 12, no, sorry, 9 months, not 9 over 12, 9 months times 1.2 million a month. That gives us sales of 102,700 after adding both parent and 9 months of the subsidiary and subtracting the intercompany trading. We then move on to cost of sales. Cost of sales, there are going to be quite a few things we're going to have to adjust there. So if you are not very sure of doing the working in the cell, you can simply reference it. Remember, there's the fair value adjustments have to go there. So let's put a working there. Let's put a working there, and then we'll do cost of sales somewhere on the side. Let's come to the side, call this working one. Sorry, working one, cost of sales. Okay, so cost of sales for the parent is going to be 58,200. Subsidiary is going to be 9 over 12 times 34,000. Remember, we have to subtract the intercompany sales, intergroup trading. How much was the intergroup trading? We agreed that was 9 months. No, I don't know why I keep doing over 12. 9 months times the 1.2 million. Okay, so that has to be subtracted. Another thing that goes in there is, remember we had an asset that had a fair value above its carrying amount. So the depreciation, the excess depreciation on this is going to increase our cost of sales. Okay, don't subtract it. Depreciation is an expense. It doesn't reduce your cost of sales, it increases your cost of sales. So how much is the depreciation? Less the excess depreciation. First of all, the fair value was 4 million above the carrying amount, and they told us at the date of acquisition, meaning at 1st Jan 2016, this asset had a useful life, remaining useful life of 2 years. So when you do that, that gives you the depreciation for the entire year. 4,000 divided by 2 years gives you depreciation per annum. But then we didn't have this planned for the whole year because we only had this. Remember, the acquisition was a mid-year acquisition. So we need to time a portion by multiplying 9 out of 12. Okay, because they're saying at the date of acquisition, the remaining useful life was 2 years. Date of acquisition was 1st January. So 1 year would then end on 1st Jan 2017. So we can't keep the entire year's depreciation. So the excess depreciation there is 1.5 million. We then have to do the fair value adjustment for inventory. Why do we have to do the fair value adjustment of inventory? Inventory was supposed to be 1 million, but they included it. Okay, at the date of acquisition, they included it at 800,000. Although they've told you that all of this inventory has been sold by 30th September 2016, meaning it's no longer in closing inventory, but it was opening inventory, okay? At the date of acquisition, opening inventory should have been recorded at 1 million, but it was recorded at 800,000. Now think about what opening inventory does to cost of sales. If you recall your cost of sales formula, it's opening inventory plus purchases minus closing inventory. So opening inventory is supposed to increase cost of sales, and you were supposed to have recorded opening inventory at 800, but you recorded it at, you were supposed to have recorded opening inventory at 1 million, but you recorded it at 800,000. So your cost of sales have to be increased by 200,000. Okay. So, sorry, this is not a less excess depreciation. This is supposed to be an add. Okay. It increases, the depreciation increases cost of sales. Then fair value adjustment for inventory. Add the difference, 800 and 1 million, that's 200,000. And lastly, remember that on the intergroup trading, we are supposed to calculate the unrealized profit. Unrealized profit is going to increase our cost of sales so that our gross profit reduces. Let's read the details on that. They said that L'Oreal had 1.8 million of the goods in inventory, and these goods were sold at a markup of 20% on cost. So that 1.8 million is basically the cost price to L'Oreal. The cost price to L'Oreal, meaning it's the price at which Rakewood sold to L'Oreal. And remember, Rakewood took its cost, on top of its cost, it added 20%. And that's the value it sold to L'Oreal at. So the profit element is the 20%. Okay, so that's the one we need to remove from the 1.8 million. So how are we going to do it? Since this is markup, we do 20 out of 120 to get the profit element times 1.8 million. So unrealized profit there is going to be 300,000. And is there anything else that we need to include in cost of sales? Let's give it a quick glance. We've already taken into account the fair value adjustment. NCI is not going to affect this. We've done note number 3. The note number 4 is on investment income, which doesn't affect cost of sales. So yes, we're sorted for our cost of sales. We can now get the total. If you put a negative sign, let's do that, in fact. The one where I have to subtract, I'm simply going to put a negative sign there. Okay, so that if I use the formula sum is equal to the sum, then I get the right answer. If you did not put a negative sign, then do not use the sum function, individually do the addition subtraction. So the cost of sales is 74,900. You come to your main pro forma there and put is equal to and cell reference that. Okay. So now we can do our gross profit. Gross profit is going to be our sales revenue minus our cost of sales. That gives us our gross profit. We then move on. Selling costs. Straightforward there, nothing to adjust. So we're going to pick 2,000 for the parent plus, of course, not really nothing to adjust. We have to do the 9 out of 12 for everything of the subsidiary. So times 9 out of 12 there. So that gives us 3,200 on selling costs, then admin expenses. Same thing, get the parent 4100 plus 9 over 12 times, how much was admin of subsidiary? 2,800. Okay, that gives you admin cost. Then we get our operating profit. Operating profit is going to be our gross profit minus selling minus admin. Gives us 28,400 there. Then investment income. Investment income. Now they told you that the investment income is 500 for Laurel and 400 for Rakewood. But then remember the note number 4. Note number 4 said that Laurel's investment income consists of each share of dividend of 500,000 paid by Rakewood. So let's see. Let's go to the side and see. Each share meaning 60%. So 60% times the 500,000. That gives us 300,000. That means the dividends attributable to Laurel from Rakewood were 300,000. And it's saying a dividend of 200 was received from Arctic, which is an associate. Okay, so 300 plus 200, that's how the 500,000 is made up. But we know that dividends from subsidiaries and dividends from associates are not supposed to be included in the consolidated SOPL. They are intercompany items. Okay, they are eliminated on the consolidation. So I'm going to completely ignore the investment income of the parent, but of course we are entitled to the investment income of the subsidiary. Okay, so investment income of the subsidiary was 400,000, but we're only entitled to 9 out of 12 of that amount. So 400 times 9 over 12 gives us 300,000 on investment income. That gives us profit before financing and income taxes is going to be operating profit minus, plus, not minus, plus investment income. That's your profit before financing and income tax. And we have interest expense. Now don't forget to do the unwinding of the discount here, okay? So interest expense is 300 of the parent plus whatever you calculated as your deferred consideration here, okay? You are going to have to pay interest at the rate of 8%. The cost of capital that you used for the discounting is the same one that you use for unwinding. But then remember that this interest expense is not going to be applicable for the full year because the acquisition happened on January and the year is ending on September. So again, this interest expense is only going to be a 9-month expense. So times 9 out of 12. That gives us our interest expense of 1110. And then we get our profit before income tax. Is equal to 28,700 minus the interest, and income tax is 4,800 of the parent plus 9 out of 12 times the subsidiary's income tax. So 7.5 is our income tax, giving us profit for the year of how much? Get that and subtract the income tax. That gives us 20,090. I think that's not, let me check my answer once again. There is one thing which we've forgotten. Remember, there's an associate. That means we are entitled to the profit. The parent is entitled to the parent share of the associate's profit. Okay, that comes after operating profit. So I'm simply going to push my workings somewhere. Hold on, I need to create a line there, and I'll bring them. So that's going to be share of profit from associate. Share of profit from associate. If we look at the associate, where is our associate? Note number 4. They're saying that we as in the parent, owned 25% of the associate, and associate's profit for the year was 2.4 million. So since we owned it from several years back, there's no need to apportion the profit. We're entitled to the full year. So 25% times 2.4 million. And that changes our workings. So that's going to be operating profit plus investment income plus share of profits of the associate. Interest expense is fine. That's going to change. And that's your profit for the year there, 2690. Okay, so lastly, obviously, we need to give out attributable to parent and NCI. And we said we always start by working out the NCI first, isn't it? And then the balancing figure will be the profit attributable to the parent. But then we're going to have to do a bit of the adjustments because the subsidiary had some adjustments regarding the fair values and the intercompany trading. So what we'll do, we'll come to the working. We'll call this working to. Okay. So working to NCI's share of profit. Start with subsidiary's profit. How much is subsidiary's profit? Remember, we can only take 9 out of 12 of the profit for the year. So you can see Rakewood's profit for the year was 10,400. So it's equal to 10,400 times 9 over 12 of that amount is 7,800. Now, it was the subsidiary selling to the parent. Remember, there was intercompany sales. The subsidiary was the one selling to the parent. And that means that in the subsidiary's books is where you'll find the unrealized profit that we calculated. And since this profit has not yet been realized, we cannot say that it's been earned. We need to reduce the amount of the subsidiary's profit by the unrealized profit. So less the URP, simply pick the figure from up. We've already computed it. We also agreed that there's going to be depreciation because there's a fair value adjustment on the plant. There's going to be excess depreciation, and that would reduce the value of the subsidiary's profit. So less the excess depreciation. Again, pick that figure from up. We've already computed that. And remember, the inventory. We agreed that opening inventory was supposed to be higher than they stated. So opening inventory reduces the value of the profit because opening inventory increases cost of sales. Okay, so we're supposed to reduce the profit by that amount as well. So I'm simply going to go and pick that from there, and that will give you your adjusted profit. So 7,800 minus 300 minus 1,500 minus 200 gives us the adjusted profit of the subsidiary, and from that we simply get the NCI share is going to be 40% of that amount. Percent times 5,800 gives us 2320. So go there, go to your pro forma, and then paste it there. Is equal to, pick that figure. Okay, and we know the total profit was 2690. So how much is attributable to the parent? The balancing figure. Out of 2690, 2320 is for NCI. That means 18,730 is for the parent, and that's your consolidated SOPL done. Okay, so those are how many marks? 20 full marks out there. Okay, so moving on to the next question. So the next question is about landing company. Let's read the requirements. It's been broken into three parts. The first part is saying, after making adjustments to the financial statements of Archway Company, which you think may be appropriate for comparability purposes, restate revenue, cost of sales, interest, equity, and they've told us to assume that our adjustments to P&L result in retained earnings of 2.3 million at the year end. and non-current liabilities. So we're supposed to read the case, and whatever we think is appropriate, keeping that in mind, we're supposed to adjust all these 5 figures, and that's your 5 marks. Part B has asked us to recalculate comparable sector average ratios for Archway Company based on our restated figures in A above. So let's see the sector ratios. They must have given you some ratios down. Yes, they have. Okay, you can see they've given you some ratios. We're supposed to recalculate all these using our adjusted figures in A. And that's 6 marks for recalculating the ratios. And then lastly, as usual, they're going to ask us to comment. So comment on the performance and gearing of Archway Company compared to the retail sector average as a basis for advising Landing Company regarding the possible acquisition of Archway Company. So this looks to be a scenario where Landing Company is considering acquiring Archway Company. They've obviously given you some figures and they expect you to change them, recalculate ratios, and then give an advice. Okay, typical question around interpretation of financial statements. So let's read the scenario. Okay, so Landing Company is considering the acquisition of Archway Company, a retail company. The summarized financial statements of Archway Company for the year ended 30th September 2016 are given to us. They've told us, they've given us the SOPL and they've given us the SOFP. From inquiries made, Landing Company has obtained the following information. Archway Company pays an annual license fee of 1 million to Cardol Company, which is included in the cost of sales, for the right to package and sell some of the goods under a well-known brand owned by Cardol Company. If Archway Company is acquired, this arrangement would be discontinued. Landing Company estimates that this would not affect Archway Company's volume of sales, but without the use of the brand name packaging, overall sales revenue would be 5% lower than currently. Overall sales revenue. Okay, so remember, this is a case where Landing is considering the acquisition of Archway, and scenario 1, note 1 is telling you that currently Archway is under an arrangement where they give 1 million to a company called Cardol for their brand name. Okay, but the moment Archway is going to be acquired, that arrangement will be discontinued, and they're saying as a result of discontinuing, the overall sales revenue would be 5% lower than currently. So what have they asked us to calculate? If you recall, they've asked us to calculate the revenue and the cost of sales. This note is going to affect both those figures. Why? First of all, already we know that revenue is going to be 5% lower. And secondly, the 1 million license fee. Now, when they acquire it, the arrangement is going to discontinue. That means the license fee will not have to be paid, okay? And the currently included in the cost of sales is the license fee. So obviously, the cost of sales is going to reduce by the amount of the license fee as a result of that. Then note number 2 says, Archway Company buys 50% of its purchases for resale from Cardol, one of Landing Company's rivals, and receives a bulk buying discount of 10% off normal prices. This discount does not apply to the annual license fee referred in note 1 above. The discount would not be available if Archway Company is acquired by Landing Company. So again, now another situation with Cardol. Currently, Archway is buying half of its purchases from Cardol, and they're receiving a discount of 10% on it. And if the acquisition happens, the discount is not going to be available. What that means is that the 50% of the purchases of Archway will then be at full price. Currently, it's at 90% of the normal price because of the 10% discount it's receiving. And once the acquisition happens, if it happens, 50% of the purchases will go up in price. Okay, and they said that this 50%, the discount does not apply on the license fee. So again, that's another adjustment we'll have to do under cost of sales. Our value of cost of sales will increase. Note number 3 says the 4% loan notes have been classified as a current liability due to their imminent redemption. Let's first see the SOFP. You can see under current liabilities is a 4% loan note. Generally, loan notes are long term, okay, but then it seems that the redemption period, which it's soon due, as you can see. So that's why they've classified it as a current liability. So as such, they're not treated as long-term funding. And However, they will be replaced immediately after redemption by 8% loan notes with the same nominal value repayable in 10 years' time. So what's going to happen is that they're going to pay back the 4% loan notes, and they're replacing that very amount. You can see the value of the loan is 10 million there. They're going to get another loan worth 10 million, but this time the interest cost is going to be 8%. It's going to be double the cost. So that's why Part C is asking you to compute the interest expense as well. And then that's going to affect the interest expense. And they've also asked you to compute non-current liabilities. So remember that right now there is no non-current liability in the SOFP given. That's because the loan notes have been classified as current. But once it's replaced with the 10-year loan note, the new loan note, obviously there'll be non-current liabilities. So keeping that in mind, moving on, they've said lending company has obtained some of Archway Company's retail sector average ratios for the year ended September 2016. It has then calculated the equivalent ratios for Archway Company as shown below. So they've given us the sector average and they've given us Archway Company. Now this is before the adjustments, okay? So the first part of the question is asking us to make the adjustments to those figures, and part B is asking us to recalculate all these ratios after we've adjusted those figures. And then part C is obviously asking us to comment. So when you're commenting, what are you going to do? You're going to obviously keep in mind the sector average, the old ratios that were compared, and then the new based on the adjusted figures. That's the line of thought you're going to have in your commentary. Anyways, we'll look at that when we reach there. They said a note accompanying the sector average ratios explains that it is the practice of the sector to carry retail property at market value. The market value of Archway Company's retail property is 3 million more than its carrying amount. Ignore the effect of any consequent additional depreciation, and this gives 12,000 square meters of floor space. So when we're going to calculate some of the ratios, they've told us that the assets, okay, the sector average, they use the market value to value their retail property. But Archway, it seems, was not using that. That's why they've said that the value of Archway Company's retail property is 3 million more than its carrying amount. So we have to keep that in mind when we are computing certain ratios. Obviously, that's why they've given us a figure. And they've said that ignore consequent depreciation. Since the value of the property is high, normally we would expect higher depreciation, but they said ignore that. And they've also given us 12,000 square meters of floor space. You can see that one of the things that has been computed is annual sales per square meter of floor space. So we will use that figure there when we reach that computation. Okay. So let's get right at it. Let's start with part A, make our adjustments, and then we will move on to the rest of the requirements. So as you can see, they've not really given you a spreadsheet here. It's a Word kind of doc. So that means the calculations are not that big. Okay, so you can do your workings right in the space provided. Don't worry that there's no spreadsheet for you to compute. So the first part, let's label it part A. What are we calculating? We are calculating the restated figures. Okay. Revenue. Revenue is going to be 95,000 times, so 94,000 times 95%. That gives us 94,000 times 95%. Put that in your calculator, you're going to get 89,300. Next ratio they wanted was the cost of sales. Cost of sales was originally 73,000, okay? But now remember, first of all, this 1 million license fee that is being paid to Cardol was included in cost of sales, and we're not going to pay that if the company is acquired. Okay, so cost of sales is going to reduce by the 1 million, obviously. Then they said note 2 also said that 50% of its purchases for resale are from Cardol, one of landing company's rivals, and they receive a bulk buying discount of 10% of the normal prices. This discount has not been applied to the annual license fee. This discount would not be available if Archway is acquired by landing company. Okay, so that means that half of the purchases included there are currently at a cost of 90% because of the 10% discount. However, once this arrangement discontinues, the cost of the purchases, the 50% of the purchases, is going to be the normal price. It's going to be the 100%, isn't it? So what is going to happen is that we're going to have to adjust for that. How are we going to do that? Let's see. We're going to get, first of all, we have our how much is the cost of sales? 73,000. 73,000. From this, let's first subtract the licensing fee, which gives us 72. Now half of this 72,000 divided by 2 gives us what? What's 72 over 2? Unfortunately, we don't have a spreadsheet. That gives us 36,000. Okay, so 36,000 is currently at 90%. We want to make it, we want to increase it to the full cost price. Okay, so times 100 over 90 should give us how much? Is going to give us 40,000. Okay, so 40,000 is the new cost of the half of the purchases, which are then going to be at full price. Why did I do times 100 over 90? Because 36,000 was equal to 90% because of the 10% discount. So X is equal to 100%. We want the price without the discount. So an easier way to do it is just multiply 36,000 times 100 over 90. But that's the logic, okay? So you can cross multiply if you want. Now 40,000 is the new price of the 50% purchases. And then, of course, the remaining 50% stay at 36,000. So 76,000 is the new value for our cost of sales. We then move on to the next, interest expense. Interest expense, remember the 4% loan is being replaced by an 8% loan, but still of the same amount. Okay, so times 10 million. Because you can see the current liabilities, the loan notes are 10 million. So 8% of the 10 million gives you 800,000 as your interest costs. Then we move on to equity. They said assume that your adjustments to profit or loss resulted in retained earnings of 2.3 million at 30th September 2016. Okay, at 30th September 2016, they're saying assume retained earnings as a result of us adjusting all those things is supposed to be 2.3 million. Now, what would equity be? Equity would obviously be the total equity section, which is 10 million of the share capital. Retained earnings, they've told us to take it as 2.3 million. But don't forget, there was a note we read down. We said that the note down said, a note accompanying the sector average ratios explains that it is the practice of the sector to carry retail property at market value. And the market value of Archway Company's retail property is 3 million more than the carrying amount. So revaluation upward, okay? And remember, this would be included in the revaluation reserve. And since we are adjusting for these changes, we definitely need to include it in calculating the new equity figure. So equity is going to be the original 10 million given to us, which is, that means it's not the original, the share capital is the 10 million, as you can see up, plus retained earnings, we were told to use 2.3 million, plus the 3 million adjustment for the revaluation. When you add that along, that gives us 15,300. And lastly, non-current liabilities remain at 10 million because they're simply replacing the 4% loan with an 8%, but then they told you that the value is going to be the same. If you look at, where did they tell you? Note number 3. They said, however, they will be replaced immediately after redemption by 8% loan notes with the same nominal value. Okay, so 10 million is going to be the value of your non-current liabilities. And that's it. We have done our part A. Okay, it's not letting me delete that. Delete row. We don't need that row. Okay, so we're done with part A with our restated figures. Easy, 5 marks. Part B says recalculate the comparable sector average ratios for Archway based on your restated figures in A above. So they now want us to adjust this. So let's put it there. Part B. Again, let's use a table to make our work organized. So I'm going to put, see, for part C, we're going to have to compare the sector average, the original figures, and the adjusted figures. So I'm going to put them side by side so that our part C becomes easier. But if you don't have time, you don't need to write all that, okay? 1, 2, 3, 4. How many do we need? 1, 2, 3, 4, 5, 6, 7. So 4 by 7. Okay. So archway original figures, archway adjusted, which we're going to do, and sector average. Annual sales per square meter of floor space. Okay. ROCE, net asset turnover, GPM, operating profit margin, and gearing. They've told you use debt over equity. Okay, so let's paste the original figures there first. 7833. Can I copy this? Oh, it's giving me the whole thing. Sorry, my screen is not being so friendly, so I'm just going to type it out. 58.5%, 5 times 22.3%, 11.7%, and nil. As adjusted, we're going to have to calculate. Sector average is 8,018%, 2.7 times 22%, 6.7%, and 30%. Okay, now what are the adjusted figures? So starting with the first thing, annual sales per square meter. How are we going to get the annual sales per square meter? We're simply going to get the new sales revenue, which we computed up, and then divide it by the number of square meters of space, which they told us in this note down. They said it's 12,000. Okay, so archway adjusted, we're going to get, what was our part A is here. The adjusted revenue was 89,300 divided by 12 million. So 89,300 divided by 12 million. You don't have to do the table like I've done. Okay, I've simply done it so that when we go through part C, that makes sense to you. If you don't have time, you just don't do that section. Okay, just do the archway adjusted figures, because anyways the original and the sector average are given to you. So I was just, in case you have time and you want to be organized, that's fine. Otherwise it's absolutely unnecessary. So 89,300 divided by 12,000, that gives us annual sales per square meter of $7,442. Then return on capital employed. Remember, the formula of return on capital employed is what? Return on capital employed is going to be our return, which is in the form of operating profit. Okay, so operating profit is going to be restated. Remember, there are changes that happened. Okay, where are the figures? This was the original value they'd given us, but remember, our sales revenue changed, our cost of sales changed. That means we're going to have a revised operating profit. We're going to have to adjust the operating profit. So we're going to do operating profit divided by capital employed. Capital employed, there are two ways. You can either get total assets minus current liabilities, or you get equity plus non-current liabilities. We already know the equity figure. We've calculated it in part A as 15,300, and we know non-current liabilities are 10 million. So we can use that. We just have to get our operating profit. Okay, so ROCE is going to be, how much was our new revenue? 89,300 minus 76,000. Remember, operating profit, you have to subtract the selling and admin costs as well. So minus the 10,000, 4 plus 6, okay? Which gives us how much? That gives us let's give us 3,300 divide by, let's put it down, divide by 15,300, which is our equity, plus 10 million, which is the non-current liabilities, okay, times 100. Please don't directly get the answer in your calculator and just put it. You must show your workings, so that in case you have one figure wrong, you will be marked on the others that you have, and there's also own figure marks, okay? So please do not ignore workings. So when you do that, that's going to give you how much? 3,300 divide by 25,300 times 100% gives us 13% as our return on capital employed. Net asset turnover is simply going to be the sales revenue divided by capital employed. Sales revenue, we know the adjusted sales revenue is 89,300. Divide by capital employed is 15,300 plus 10 million. Sales net asset turnover is not in percentage. The answer is in time. So when you work that out, that gives you 3.5 times. Gross profit margin. Gross profit margin is simply our gross profit divided by sales revenue times 100. We need to get gross profit. We know the revised sales revenue is 89,300 minus the revised cost of sales is 76,000. So that's your gross profit. Divide by sales revenue of 89,300 times 100%. When you work that out, that gives us our gross profit margin as 15%. Operating profit margin is our operating profit divided by sales revenue times 100. We computed operating profit in the ROCE part, isn't it? So simply pick that figure. 3,300 is your operating profit. Divide by sales revenue, we know is 89,300 times 100. That gives us how much? 3.7%. And lastly, gearing, they said, is going to be debt over equity. Remember, the debt was the new liabilities of 10 million and equity is 15,300. So that gives us gearing at 65.4%. And that's your part B done, okay? Only this middle column was relevant. And if you're going to do, when we do part C, we can now easily compare. You can see the original figures. Look at the original figures for Archway. The annual sales was much higher, although it was below sector average, annual sales per square meter, but it has further fallen after the adjusted figures. ROCE was 58.5% originally, okay? And that was, if you look at sector average, 18%. So the ROCE originally was almost 3 times the sector average, but the adjusted figure has fallen way below the sector average as well. So that's going to be a problem there. We're going to have to talk about it in part C. Net asset turnover has also fallen. Before it was way above the sector average, but now it's fallen, as you can see. And then gross profit margins have fallen. They were close to sector average before. They were above but close, but now we're below sector average. Operating profit margin has fallen quite a bit from 11.7% to 3.7%, which is also quite below the sector average. And gearing, which was 0 before. So there was a non-current liability. I mean, that was technically not non-current. There was a loan, but because it was going to be repaid, it had been removed from non-current and been classified as current liability. So because of that, there was no gearing of this business originally. The sector average has gearing of 30%, but now after we replace it with a loan of the same amount, you can see that the gearing is shot up way above, double the sector average, more than double the sector average even, which is a case of concern, okay? So part C is now asking us that comment on the performance and gearing of Archway Company compared to the retail sector average as a basis for advising lending company regarding the possible acquisition of Archway. So I'm simply going to take you to the answer, okay? And then we'll go through the answer, the model answer in the mark scheme. But as we go through it, I want you to notice, and I'll be pointing that out, I want you to notice the flow of how you should be commenting. Of course, you don't have to use the same words. No one's going to have the same words as the examiner, but it should strike you as to what is expected, what should be written, what are the points that you can possibly write. Okay, so let me share a new screen. Let's go to the answer. Okay, so this is the comment in the mark scheme regarding the performance. So the table is there, so we can see. We have the figures there. They've told us to comment on the performance as well as the gearing. A comparison of Archway's ratios based upon the reported results compares very favorably to the sector averages in almost every instance. So the first paragraph, they're talking about the original figures of Archway compared with the sector average. And as you could see, they were very good in comparison to the sector average. Like I discussed, ROCE was almost double, net asset turnover is quite high, operating profit margin was high, and there was no gearing. Okay, but so that's the first paragraph talking about it. They're saying that Archway's original ratios were very favorable compared to the sector averages. ROCE is particularly impressive at 58.5% compared to the sector average of 18%. And as we said, it's almost 3 times the sector average. So the superior secondary ratios of profit margin and asset utilization appear to confirm that Archway's performance is above average. Remember, our ROCE is simply the combination of our operating profit margin and the net asset turnover. So if we break down this 58.5% in the ROCE, if we look at the cause of it, net asset turnover is also high, which is why our ROCE is high, and operating profit margin is also quite high. Okay, so they said that those two figures are confirming our good ROCE. Then moving on, they said it is only the sales per square meter of floor space which is below the sector average, as can be seen. It's 78.33 compared to 8,000. The unadjusted figure is very close to the sector average, as is the gross profit margin, implying a comparable sales volume performance. So since our gross profit margin and the annual sales per square feet, so say annual sales per square feet is less, but it's not very far off from the sector average. And gross profit margin is also around the same as the sector average. This means that the sales of Archway, as reported based on the original figures, the sales of Archway seem to be around the sales of the sector. Okay. However, the reduction in selling prices caused by the removal of the brand premium causes sales per square meter to fall marginally. If you look at the adjusted figures, the annual sales per square meter has fallen to 7,442. Why has it fallen? If you remember in part A, the adjustment we did, the sales fell because we were not able to use the license. There was a 5% fall in the sales. So that has led to a reduction in the selling. It led to the sales revenue reducing, which was because of the selling price. And that affected the annual sales per square meter of floor space. Now, the next paragraph, as you can see, they're going to talk about the adjusted figures. Okay. So as indicated in the question, should Archway be acquired by landing company? Many figures, particularly related to the SOPL, are going to be unfavorable, as we can see in the middle column. When these effects are taken into account and the ratios are calculated, a different picture is emerging. All of the ratios except the net asset turnover are significantly reduced because the favorable trading arrangements that they had with the original company, the discount they were getting, the license they were able to use, all those favorable arrangements are going to stop, and that impacted the sales revenue, that impacted the cost of the purchases, okay, in a negative way. So once that favorable trading arrangement stops, you can see the effects, and the most dramatic effect is seen on the ROCE. It fell from 58.5% to 13%, as we can see. Originally, it was 3 times the sector average, and now it's fallen even below the sector average of 18%. So this is quite bad. And when we analyze the individual breakdowns of the ROCE, both again are lower than the sector average. What are the breakdowns of ROCE? We said it's a combination of operating profit margin and the net asset turnover. So both of these in the adjusted figures have fallen below the sector average. No, net asset turnover is not below sector average, sorry. It's above sector average, but it's fallen below the original reported figure. And that's why our ROCE is also low. The net asset turnover is higher than the sector average, but it has still fallen, like we mentioned. Why has it fallen? Remember the formula for net asset turnover. It's sales revenue divided by capital employed. So sales revenue, we know it fell, and there was also an increase in the capital employed. Remember, mathematically, when the denominator is going to increase for this ratio, then your ratio is going to fall. And capital employed increased because capital employed, the formula we used was equity plus non-current liabilities. And there was a non-current liability, which was not there in the original computation. So as a result of capital employed increasing and as a result of revenue decreasing, net asset turnover fell, although it's still higher than the sector average. Okay. The other costs are not really very different, but we can see that the reduction in the sales per square meter of floor space, this reduction in the first ratio, we already discussed that was because the sales revenue figure decreased because of the removal of that license that we could use. So that analyzes the performance based on all the ratios. I want you to notice how they laid their answer out. They've given you original figures, the reported figures. So that's the first thing they analyzed compared to the sector average. The second paragraph spoke about the adjusted figures. As a result of adjusting, what is the new comparison with the sector average? Okay. And lastly, let's go to the gearing, because the question specifically also mentioned that analyze gearing. The gearing ratio was originally nil based on the unadjusted figures, and it was not meaningful because there was a debt. Okay, it's just that because the repayment period was closed within a year, it was reclassified as current liability. But when this debt is going to be replaced by the 8% loan notes, the gearing is much higher than the sector average. And they've not really given us information about how this interest expense compares with the industry. You can see that originally this company was able to borrow at 4%, but now the interest rate is going to be double the original interest. Is this too much? Is this normal? That would depend on what the industry averages were for the interest rates, but we're not given a figure there, so we can't comment on it. But if that figure was available, we could get an idea of the credit ratings of Archway Company. If the 8% would be higher than its industry peers, that means that this company's credit rating is not favorable in the market. That's why they're charging them a higher rate for borrowing. If it was in the same lines, that wouldn't be a problem. But again, we don't have that information, so we can't really comment anything more aside of saying that if this figure was available, we would have been able to get a glimpse of the credit status. But then one thing is that the fact that the interest rate has doubled for the same amount of borrowing. Before you were able to borrow at 4% and now at 8%, it means that there is whoever has lent the company money is assessing Archway to be a risky company. That's why they've increased the interest rate. Okay. So lastly, what is the final conclusion and advice? Remember the scenario was that landing company wants to purchase Archway Company. So what is your advice based on all these computations that we've done? Based on the reported figures, the original reported figures, it would appear that it is a good investment to make. But based on the recalculated figures, it is, as we've seen, there are quite a number of red flags there. So what you can advise is that when you're making such investment decisions, one of the important ratios in making an investment decision is what we call return on the investment, ROI, which is not something they've calculated, but you can advise that they should calculate the ROI of the investment, and they should compare it with a targeted ROI that landing company may expect. That would make more sense in deciding whether this should be this company should be acquired or not. Okay, and it would also give you an indication of how much to pay for the company. If we read the answer further, it's written that in an investment decision such as this, an important projected ratio would be the return on investment, which landing may expect. The expected net profit after tax can be calculated as 2 million. So they've simply got the operating profit and subtracted the interest and the tax figures. But there is no information on what the purchase consideration is for us to compute ROI, we need to know how much the purchase consideration would be, because it's saying return on investment. Okay, so the return we can calculate, but how much is the amount we're investing, we don't know. But then, having said that, a minimum purchase price for Archway can be computed based on the net assets that we're going to acquire. When you buy a company, how do you determine the price? You obviously look at what you're going to get in return. So what are you going to get in return? You're going to get all the assets minus the liabilities, which is the net assets. And if it's a good company, you may be willing to pay more for the goodwill. But the minimum you'll have to pay will obviously be the value of the net assets that you're going to acquire. So they've done that computation for you. The minimum purchase price based on the net asset value, you can compute the ROI. 2,000 is going to be your profit. Divide by 25,300, which would be the minimum purchase price based on the net assets. I'm not going back to the question, but you can get the net assets by looking at the SOFP given. Multiply that by 100, gives you an ROI of 7.9%. 7.9%, is this good or bad? We can't comment without knowing the existing ROI of the company. But what we can say is that anything, when landing company is making the deal, anything that they pay above 25.3 million is going to make the ROI further fall down. And they should consider that in the negotiations, especially given the fact that the adjusted ratios are not so good. So it is possible that, now look at the other side. It is possible that under landing company's management, Archway's profits can be improved, perhaps coming to a similar arrangement regarding access to the branding sales. They said that we're going to lose access to the branded, the license, and we're going to lose the discount. But maybe after landing acquires the company, it can enter into such favorable arrangements. But maybe with a different company, because Cardol is a direct competitor, okay? And if that's the case, if landing company can manage to do that, then Archway may be a good acquisition, perhaps, okay? So that's your final conclusion and advice. Obviously, it sounds so big when it's described like that. And you don't have to have the same English. What I want you to notice from here is that, like I told you, what is the flow in which they've spoken about and what are the things that they've spoken about, okay? So clearly they've spoken about performance and gearing because that was asked in the question, but don't forget to give your final conclusion, okay? That is essential. That gives you marks. And that brings us to the end of this question and the end of the debrief for the section C. All the best. Keep practicing.